Hello friends, welcome to yet another video in our series Finance and Investing Tidbits. The theme of this video is increase your dividend potential through investing and holding companies. I am sure you would have explored a lot of videos that I have created on investing and holding companies. There is a detailed video of 1 hour 30 minutes talking about the rationale why I moved to investing through investing and holding companies. Then there is another video on how to calculate NAV and so on. Please explore my channel. And of course, in the description box of this video, also I will provide those links in case you have missed them. Great. So let's get going with this interesting video. Before I go further, friends, I would like to give a disclaimer and a disclosure. The disclosure is that over the last 12 years, I have invested a very significant proportion of my investments through holding and investment companies. So naturally, I have a certain bias, a very favorable bias in favor of investing through this route. And therefore, the disclaimer I would like to give is that I would like to encourage you to independently verify the contents of this video to build your own conviction, and therefore you need to kind of do your due diligence before you take an investment decision. I would also like to explain that I am not an authorized research analyst or a portfolio manager under SEBI registration, and therefore I always make it a point to give this disclaimer and disclosure, as well as I never talk about any individual companies, but I only talk about the principles involved and the opportunity involved. And I welcome you to explore that opportunity through this video. Investing in shares has two main objectives: capital appreciation and dividends. Capital appreciation is always the major one. We would like our investment to grow in its price. But dividend is also important, and I consider that as important for de-risking, as de-risking is also important in equity investing. De-risking means, apart from many other dimensions of de-risking, one of the dimensions is that we must have a discipline of taking money out of the market. And that can be achieved in three ways. One is dividend, second is you sell shares, and third is you surrender your shares in a buyback. This taking money out of the market is a very, very important discipline. And to that extent, dividends also play a very constructive role. And when you are able to multiply your dividend opportunity through investment and holding companies, as I'm going to explain in this video, it's going to help you to de-risk, because you're going to take out larger dividend than you would receive if you are not to take this route and you are to invest in individual companies. So let's explore that very interesting logic. As I've already mentioned, I have created many videos explaining the ideas of holding and investment companies, and particularly how it provides a wonderful defensive investing opportunity for retail investors. What I mean by defensive is that it's something which should help you to manage your mind, because the biggest error which happens in the stock market is that you sell when the markets have collapsed. You don't sell when it's a good time to sell, which is, the markets are on high, right? But the fear has to be managed well, and that's where this defensive aspect becomes very important. Holding and investment companies trade at a significant discount to their NAV, and please explore those videos to understand the more detail of it and why the paradigm of that discount is likely to undergo some change. But this is my own perception, and therefore, as I mentioned in the disclaimer, you need to do your own due diligence. But in this video, I'm going to specifically talk about how investing through holding an investment company route enhances your dividend potential while minimizing the risk due to the discount at which they are trading. Who doesn't like discount? If you're buying even onions, we like discount, right? So why not in shares? So let's explore that dimension. In the detailed videos that you can explore, I have explained how the Section 80M as framed in the budget of 2020 has incentivized companies to pass on dividends they receive to shareholders. Now, this is particularly applicable to holding and investment companies. Of course, other companies also receive dividends as a passive income uh, because they have an inherent operating business. So their dividend is influenced by their profitability of that business, not so much about the dividends that they receive from those passive investments. But in case of holding and investment companies, dividend income is the major income. Now, again, I'm not getting into the details of this Section 80M right now. Do explore those videos that I'll provide a link in the description box. But my point is that with this shift, the holding and investment companies are going to be incentivized to declare more dividends, right? Particularly because they are primarily focused on a share portfolio, they receive very significant dividends, and they would not have to pay any tax on these dividends if they pass on the dividend to shareholders. Since they get to hold the dividend between receiving it and declaring it, that also gives them a float which they can invest for a certain period, and they also have a fixed income portfolio. Now, both these can result into an interest income for them, which is usually sufficient to take care of their administrative expenses. So once their administrative expenses, including employee salaries, are taken care of, the dividend as a pool is available for distribution, and still they can retain some profits within the firm. So that great incentive is working. Let's explore more dimensions of it. Here again, as I mentioned in my disclaimer and disclosure, I'm not taking any names, right? In one of the videos, I have talked about the universe of these companies, right, as illustrations, and you can of course explore more. So here again, I'm just explaining the principle. Let us say that we are proposing to invest in a company called as XYZ Holding Company, which has invested in 5 companies, A to E. Out of those, A, B, C are group companies and D and E are non-group companies. That means they have invested in completely different companies. Following are the details of the number of shares held in those respective companies by XYZ. So here you can see those 5 companies A to E and the number of shares XYZ holds in them. Here I'm not complicating with the data by saying how much percentage of A are they holding, how much percentage of B are they holding, etc. We have nothing to do with it. We have to do with the absolute number of shares. So they have 1 crore shares of A, 60 lakh shares of B, etc. Let us further say that XYZ company itself is a listed company. Naturally, we are all interested in listed company space, and they have issued 1 crore shares to their own promoters or public, as the case may be. They may be, say, 50% with the promoters, balance 50% with the public, including FIIs and institutional investors, right? Let us say that is the situation. Let's explore further. Friends, as you can see in this table, let us find out what the current market value of the entire portfolio is. So here, as you can see, the number of shares have been listed and the current market price has been populated. So for example, company A has the price of 250 rupees a share, B has 150, etc. If you multiplied the number of shares and the current market price and divided by 1 crore, because we want to have the market value in crores, we will get the answers in the last column. So obviously, company A, the total collective price, which we can in common parlance call it as market value, is 250 crores, B 90 crores, and so on. In other words, the total market value is 605 crores of this entire portfolio. If you are looking at the annual report of the company, the shareholding is reported under non-current investments if the intent of the company is to hold those companies shares for a long time. And obviously when it comes to group companies, companies A, B, C, it would be a part of their long-term investments, which in the balance sheet it is reported under non-current investments. But it is also quite possible that the company may have a current investment portfolio. Current investments or these investments reported under current assets would typically be those where they may hold it for short term with an intent to trade in them or sell them. That is also possible. So you'll have to look for both the non-current assets and current assets and look for the financial investments which have been done by this company, and you'll be able to get those details. And I have created a detailed video on how to calculate NAV, etc. So let us now explore this dividend aspect more in detail. Before I go to that dividend aspect, now since XYZ itself has issued 1 crore shares overall, by dividing 605 crore of the entire portfolio value by 1 crore shares, we get the NAV as rupees 605. It is simply 605 crores divided by 1 crore. Now crore gets knocked off and the NAV is 605. It would also have other assets. Sometimes they may have some other properties, land. If the land is very significant, of course, you need to also take that into account. But if it's a pure play investment and holding company, it may not have much of other assets or liabilities. So we can simply focus on the investment portfolio itself. So if there are other assets and liabilities, you can factor them. But if they are minor, you can simply ignore. That's not going to make much of a difference. Now, again, as a part of my own disclosure, I must mention here that I have 3 holding and investment companies, which 2 of them I've been holding for 12 years plus. One of them I discovered a couple of years ago and I've been holding it now as well. So when I calculate the discount to NAV, and I'm going to show you how that can be calculated very quickly, though of course that's not the purpose of this video. Currently, what I notice is that the range of discount is 64% to 82% on the day I'm creating this video. It's amazing, isn't it? Probably the market has not yet understood the dividend potential, or it has a view completely different from mine. Now, I leave it to your judgment. Please see my other videos, as I mentioned, explaining investing through these companies in detail. Now, let us see whether this discount will shrink, because as people realize the importance of investing through such companies and they realize the impact of the change in tax laws. For now, let's focus on the dividend potential. Now, let us say that the price at which this particular share is trading is 200 rupees. As we've already seen, the NAV is 605, price is 200, so the discount amount is 405. Now, if you express 405 with reference to 605, which is the NAV, you can find out what is the discount. And the discount in this case, that is 405 absolute amount of discount divided by 605, would work out to 66.94%. And that is how significant the discount here also is. Again, this is hypothetical example, but just to illustrate how the discount is worked out. Now, let us say you have rupees 10 lakhs to invest, okay, as a retail investor. Now, what could you do? You have 2 choices. One choice is to buy shares of XYZ holding company. How many shares can you buy? You have 10 lakh rupees and the price of this holding company is 200 rupees. So 10 lakhs divided by 200, you will find 5,000 shares of XYZ holding company can be bought by you. Remember, 5,000 multiplied by 200 gives you 10 lakhs, and that's how we have got this 5,000. Alternatively, suppose you were to replicate the portfolio, exactly what this company, holding company XYZ, is currently having. You could personally directly buy shares of A to E. Now, since you have rupees 10 lakhs, which is equal to rupees 0.1 crore, and the portfolio value is 605 crore, by multiplying the quantity held by XYZ by 0.1 divided by 605, it is simply arithmetic, we could get those quantities, right? So whatever is the quantity, say 1 crore shares of A are being held by them, you multiply it by 0.1 divided by 605, you can get the quantity that you can buy, and you can do it for B to E. Now, let us say you are able to buy these many shares applying this logic. So if XYZ has in its portfolio, which is of 605 crores, 1 crore quantity of company A, you multiply it by 0.1, divide that by 605, you will get 1653 shares of A you can buy with those 10 lakhs. Similarly, you can buy 992, 496, 579, 909 shares. Now, of course, I got fractions in those answers, I've just rounded them up or rounded them off to the nearest integer. So to that extent, the amount would be slightly more than 10 lakhs in this particular case, but it's not going to make any material difference at all. Now, just to build this arithmetic further, let us say we have the shares held by XYZ. We have the number of shares that we could directly buy, which are 1 crore 60 lakhs, 30 lakhs for XYZ, and for us 1653, 992, 496, etc. Let us say dividend per share declared by the respective company, company A, B, C, D, E, is 5 rupees, 2 rupees, 1.5 rupees, 3 rupees, 3 rupees respectively. So how much dividend income would the company get if you multiply by the number of shares and the dividend? You will get 5 crore, 1.2 crore, etc. So totally this company can receive a dividend of 9.35 crores. And at a personal level, if we were to hold those respective shares of 1653 to 909, we would get a total dividend of 15,457, which again will have the same proportion by and large. Multiply by 0.1 divided by 605, you will be able to get that dividend. So remember this number, you will be able to get a dividend of 15,457 if instead of investing in the holding company, you were to invest in those A, B, C, D, E companies. Then naturally that dividend will be 15,457. Of course, we are assuming here that the proportion in which I will invest in A to E is exactly in the same proportion. Now, of course, I'll talk about this proportion part in a moment, but let us remember 15,457. Now, with change in section 80M, if a company passes on the entire amount of dividend to its shareholders, it would not have to pay any tax on the dividend income, as I have already explained. In case of those three companies that I hold, I have already experienced this in case of one of those three companies. In the year 21-22, the dividend per share increased very, very significantly. It went up a little more than 3 times, right, as compared to 2021. So this is something very significant, right? In the other two, I do expect it may happen down the line. I'm waiting and watching. So of course, I'm going to discuss these nuances a little more. What is the caution that we need to exercise and while selecting such an holding and investment company, apart from the other aspects that I have detailed in other videos. Now, if this company indeed passes on the entire amount of dividend received to the shareholders, it can pay 9.35 per share. How do I get this number? Remember, the company received a dividend of 9.35 crores. You divide that by 1 crore shares, you will get exactly 9.35 per share. Of course, the company could also declare dividend out of its non-shareholding related portfolio. So it may be their fixed income portfolio on which they earn interest, and from that also they can pay dividend. But for a moment, let me keep that aside. That is something which will be an add-on bonus for you. Let me assume for now, like I mentioned earlier, that whatever is the interest being earned on that fixed income portfolio is actually sufficient to meet the administrative expenses, including salaries and the CSR obligation that they have, etc. So for now, let's just stick to 9.35. Now, if this shareholder were to own shares in XYZ instead of those individual companies, then as we had already explored, the shareholder would be owning 5,000 shares. If you multiply 2 5,000, 9.35, your dividend goes up to 46,750, right? So it's much larger than what we had seen earlier. If I remember right, the dividend that you would have received if you had invested in the individual companies would have been 15,457. I'm sure you may have written it down also. As compared to that, we see that it is clearly 3 times the dividend that we can receive through this route, right? So let us analyze this further. One limitation of this approach is that it assumes that the shareholder would buy exactly in the same way XYZ has bought, which need not be the case. But here, of course, I'm just explaining the logic of dividend multiplier effect. So I had to hold in the same proportion so that we don't have too many variables which are working together. Also, in some holding companies, this is something which is very important. Dividends from one company are used to inject capital into other companies because those companies need capital injection, for their sustenance and, because of the nature of the business. Now, you should not, in my view, buy such a holding company at all because, obviously you don't have a control on how much money those companies would need in terms of support, and all the dividend income of this company from other companies which are doing very well may all get sucked by this one bad apple. So therefore, as I have explained in my other videos, we have to do diligence on their investment portfolio, right? Of course, one here or there is not going to make a difference, but if that is going to suck a lot of capital, this is where you have to be very careful. So what I mean by suck capital is because that company is in a growth phase or because of the nature of the industry it belongs to, it all the time needs hand holding, right? So it's not able to generate good free cash flows. On the other hand, it involves diversion of money being received from by way of dividend from other companies. So that is completely avoidable. So through the holding company route, the potential dividend, as we had seen, went up 3.02 times, 46,750 divided by 15,457. Now, is there a relationship between the holding company discount and the dividend multiplier? There very much is. The dividend multiplier is equal to 1 divided by 1 minus holding company discount. Now, in this case, it was 66.94% or 0.6694. So it is going to be 1 divided by 1 minus 0.6694, which is 1 divided by 0.3306, which is equal to 3.02. And we actually experienced that kind of a multiplier. You can thus multiply your dividend by so many times while also taking advantage of a few aspects which I have detailed elsewhere. But very quickly, it helps in mind management, it reduces risk due to buying at a discount, and thirdly, you also get access to a portfolio. So finally, I just want to give you a table in terms of how large the dividend multiplier could be. And I told you that one of the companies that I currently hold, it has 82% discount. Now see the discount range 40 to 80% and see the multiplier. If it is 40% using the logic that we have just used, it is 1.67 times. That's not bad at all. 50% is 2 times, 60% is 2.5 times, 70% 3.33 times. We had seen 66.94%, it was 3.02 times. And if it is 80%, it is 5 times. So you can multiply your dividend income. Friends, I hope you like this video and got value. For more such videos, do explore our channel, Dr. Abhijit Fadnis. Thank you so much.